I got a call and he said, look, if you're a real estate developer, you need cheap source of liquidity. You got to come to my event because there's going to be a bunch of private lenders and they're really going to be able to show you how they can save you money versus what you're doing today. So we went into this private lender conference as real estate investors and developers. We walked out as private lenders. We've never looked back since.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point podcast listeners. Thank you again for jumping into yet another episode of the Freedom Point. I'm so glad you're here with us again today. I've got another amazing guest. I've got Ruben Izgelov joining me today. Ruben, welcome to the show.
Jeremy, thank you so much for having me. It's a pleasure to be here.
Yeah, thank you for joining us. I'm really looking forward to this conversation. I think Ruben's going to bring a lot of value to a topic that me personally, as well as I think a lot of our listeners, just lack some knowledge and understanding. Just to give the audience a little bit of a background on Ruben, he's a real estate entrepreneur with over a decade of experience acquiring, flipping, developing, and financing over $500 million in real estate. So all that said, I know that there's a lot more color to your background, your story, your journey. And Ruben, I'm just going to have you kind of take it away. Let us know a little bit more about Ruben and what makes him tick.
Sure. So I appreciate it. Thank you so much for having me. Definitely looking forward to this podcast and educating your viewers and your listeners to what we do and how we can help them on their future growth and acquisition. So we are private lenders. We lend to real estate operators and investors nationwide, predominantly in the Northeast. Since inception, we've originated and deployed a little under $700 million across about 1,400 loans across the U.S. But like I said, really kind of the focus is the Northeast. So New York, New Jersey, Connecticut, and then the Eastern Corridor, so the Carolinas, Florida, and alike. Most of our borrowers, if not all, are real-time, full-time operators who are in the business of real estate, right? They buy properties that are physically, financially distressed. They reposition them, and ultimately they flip the properties to either an end user or into a long-term product and actually really kind of try to build a portfolio for themselves and their future generations to come. Prior to launching WeLend, me and my partners, who are the partners that WeLend today, we were buying, selling, flipping, developing real estate throughout New York, predominantly in the Brooklyn, Queens area. And the way in which we kind of stumbled across debt, real estate lending, is actually coincidentally. So myself, right after law school, I just wanted to find a cheaper source of liquidity for the deals that we were buying, selling, flipping, developing. And I got a call from at that time, a gentleman who was actually running one of the largest private lending conferences. And he said, look, if you're a real estate developer, you need cheap source of liquidity. You got to come to my event because there's going to be a bunch of private lenders and they're really going to be able to show you how they can save you money versus what you're doing today. And at that time, we were using like the true private hard money lenders who were pulling up on their Mercedes, looking at the property, not even doing an appraisal or anything to that effect, and just kind of giving you money based on how they look at you and view you. So we went into this private lender conference as real estate investors and developers, thinking that we're going to find a cheaper source of liquidity. We walked out as private lenders. We've never looked back since. And I think one of the biggest decision-making factors to that decision was really because we found that we can make equity-like returns just being in a much safer part of the capital stack, right? Being a lender, you're the last one into the deal, but you're the first one out. Before anyone takes out their money, hard-earned money, blood, sweat, and tears, you as a lender are repaid first. So that's what really attracted us to the space, is the fact that we're able to hit equity-like returns while being in the safest part of the capital stack.
Yeah, no, I appreciate that background and thank you for kind of sharing, your story and what you're focused on. I would be remiss not to ask you some more questions about this concept of the capital stack and private lending. So I would say most of our listeners understand that you've got the senior lender and you've got this kind of, preferred equity and then you've got common equity, right? So can you kind of explain to us a little bit more about, why specifically an operator that is currently managing a property might need to have some additional equity brought into the deal, number one? And number two, can you explain the difference between debt funds versus private equity funds?
Totally, totally. So it's a very good question. I mean, to your first question, two good questions. To your first question about why would someone want to use a debt provider, and then why would they even need equity after that, right? So we as lenders, we want our investors, our borrowers rather, to be aligned with us. Just like our investors in our fund want us to be aligned with them in the sense that they want us to have skin in the fund. They want us to be invested alongside them. We want our borrowers to be invested alongside us. So we would never provide a borrower 100% financing, right? We usually provide, depending on the borrower's experience, depending on the asset, depending on the geo, the location of the asset, we would probably, again, depending on those factors, probably lend anywhere between 70 to maybe 80, 85, maybe even maximum of 90% of the purchase price, right? And the 90% purchase price borrower is really a superstar borrower, the one that's really been borrowing from us from end to finish a number of occasions. We've seen them perform and so on. So in that instance, the borrower always has to come with equity to the table, right? Whether it's 10%, sometimes even 30%. So that's why they would always need to kind of raise additional equity. Now, some of our operators, they are syndicators, right? They essentially kind of pool money together from both debt and equity, bring the deals together. They get their fee and they move on to the next deal. So, the reason why a lot of, like, to your question, the reason why a lot of borrowers are raising equity is because, again, they need that equity to be able to provide, to be able to fill what the debt is not filling. As far as, I think your second question is, what's the difference between debt, first lien positions, and preferred equity? Was that your second question?
It is, yeah, and kind of to add more color to that, I'm just kind of curious to know, is there a major difference there? And from an investor's perspective, is one maybe more preferred over the other because of either risk or potential tax benefits?
So there's a number of reasons, right? So in a syndication, obviously there is depreciation and tax benefits when it comes down to that. The challenge with investing into a syndication is that your money is locked up, right? And it's locked up with no cash flow for some period of time, right? Sometimes it could be 8 months, sometimes it could be a year and a half, 2 years, depending on how big the asset is and what the repositioning looks like. So I think that's one of the biggest, differentiating factors is, one, you have this tax benefit of depreciation, but also you have this issue of a lockup with no cash flow for some period of time. The difference with a debt fund, when investing into a debt fund, is, one, you're able to really hit diversification, right? And the reason why I say that is because when someone invests into a debt fund like ours, your money is essentially kind of broken down and made into a number of different loans, right? So your money is never invested directly into one specific asset, to one specific borrower. So it's diversified amongst a number of different asset classes, borrowers, locations, and alike. In addition to that, when our investors invest into our fund, they get monthly cash flow almost instantaneously. So within about 45 to 60 days, they start receiving direct deposits into their bank account, because, again, our borrowers are making monthly payments to us. Why shouldn't we make the monthly distributions to our borrowers? But also, the lockup period for our investment is only 12 months, whereas some syndications, their lockup is anywhere between 3 to 5 years. So that also, that ability to be able to move around and have that lockup period being very short window of time really provides a lot of flexibility and attraction to the debt space.
Yeah, that makes total sense. And I appreciate that background. What would you say are some of the more common mistakes that you see both borrowers and lenders making in the private lending space?
Evaluation. Very simple answer. So I think that's one of the biggest challenges that a borrower and a lender kind of compete on, right? is a bar, and it's the right thing to do from my perspective as a borrower, is that, you got to look at the asset from a different lens, right? You got to be a little bit more optimistic as to what you can do. And sometimes you having boots on the ground on that specific street, on that specific pocket of the neighborhood, really provides different type of transparency and level of view than a lender who really kind of lends nationwide. So I think one of the biggest challenges that we have with our borrowers is the evaluation, right? We like to be conservative. As lenders, you have to be conservative. A lot of our investors, they're high net worth individuals. There are architects, attorneys, dentists, and alike. They are looking not to become rich, they're looking to stay rich, right? So I think for us, when we look at lending against a specific asset class, we're looking at it from a risk mitigating standpoint of view versus a borrower is looking at it from more of like an opportunistic standpoint of view. So their evaluations, we don't usually align on those evaluations. We're usually about 10 to 15% off from the evaluations. But we understand, what our setback is as private lenders. We understand that we are private lenders, right? So we have to be able to be flexible and work with the borrowers and make sure that we can get them to the finish line, just as we have for 1,400 loans that we've originated. But the challenge outside of that is that, although I'm a lender and I'm a direct lender, right? We manage our own money. We have credit facilities, right? We have warehouse lines that we essentially have to kind of answer to, right? For me to be able to hit, equity-like returns for my investors in the mid-teens, I need to be able to use leverage, right? I need to have a credit facility that enables me to hit, equity-like returns. And because of us having to use leverage to be able to hit higher returns to our investors, we have someone to answer to, right? It's kind of a check and balance, right? So while we like to be flexible, we can't be overly flexible, which is a good thing, right? Because our investors want us to be conservative, and having that credit facility that kind of is like a big brother overseeing every loan that you make, because if you don't make the loan based on the parameters that they're comfortable with, you can't put on the warehouse line. And if you don't put on the warehouse line, you're not hitting the returns that your investors are expecting to hit. That in and of itself kind of directs us as private direct lenders to be able to do the right thing for both the borrower and our investors.
Yeah, Ruben, thanks for that background and that breaking that down for us.
I'm Zach Haptonstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investor. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
I'd love for you to, in layman's terms, explain to our listening audience why leveraging debt or levering debt helps to increase or juice investor returns.
Totally. So there's this beauty of arbitrage, right? And I'll use a simple example. Let's just say we have a loan that we've made for $1 million, right? And we made the loan at a 12% rate to the borrower, right? That means that the borrower is paying us about $120,000 a year, $10,000 a month in monthly interest-only payments. We have the ability to take this $1 million loan, and again, we're going to use layman's terms. It's a lot more complicated than this, but we have this $1 million loan that we are able to go to a warehouse provider, a lender. It could be a private debt fund. It could be a community bank. It could be a state chartered bank, a federally chartered bank, what have you, right? There's a lot of different type of avenues and vehicles for that. And we have the ability to lever that $1 million loan and get back an advance and pledge it against that warehouse line of about 75%. So assuming we get a 75% advance, a pledge against our $1 million loan at a 9% rate, because this private debt fund, they're comfortable at 9%, right? They're a lot safer than we are. They feel more comfortable. So all they want to earn is 9%. And let's just say it's on against $750,000. 9% against $750,000 brings us to about $67,500 if my math serves me correctly. And so that's my only cost towards the interest that we have to pay against the $750,000. but the borrower is paying me 120,000, right, a year, and my only equity in the deal remains to be only 250,000. But now my net interest after I pay the 67,500 is 52,500, right? So that's my net interest earned against my $250,000 equity remaining in the deal after I received an advance of 750,000, which brings me to about a 21% return on the fund level from me and my investors. And again, it gets complicated. I usually, whenever this question gets picked up by my investors, gets brought up by my investors, I like to take a pen and paper and just kind of break it down because there's so many moving parts. It's a lot more complicated than I just described it. But that's just going to be like a very shortened version for people to understand exactly how, debt providers are able to hit those 20% returns. Meanwhile, they're only making loans at 12%.
Yeah, absolutely. And Ruben, I suspect that we'll have some listeners that will hit the rewind button about 2 minutes and re-listen again to what you just said. So I appreciate that. Kind of the next topic I want to talk about is it's kind of an interesting one because I'm going to say, in today's high rate environment, but not really, right? Because if you move the lens out further, are we really in that high of a rate environment? Maybe we are relative to the last, 4 years or 5 years, but how is it that you and your firm, are adapting your lending strategy to stay, competitive while still also protecting investors' returns?
So, one of the things that we pride ourselves is the service that we're able to provide to our borrowers. We never want to be competitive on, I want to say the rate. We want to be competitive on other terms, but the rate is not something we want to be competitive on, right? We try to do our best to make sure that our borrowers, we're not too far apart from other competitors. But what we really pride ourselves is being able to provide the service that most lenders cannot. Today we run a small and nimble private lender. We have about, I want to say, between 30 to 40 people on our team. So any person that, a borrower speaks to is usually one person removed or directly reporting to one of the decision-making people, right? That's myself, Moses, who is head of underwriting, or Solomon, who is head of originations. So, one of the things that we can do is move quick, right? We pride in the fact that we're able to close sometimes within 24 hours. We get calls on a Sunday night. We're at the closing on a Monday, right? So what we like to compete on is really the speed and the service to be able to execute. But to your question, as far as, all the volatility that may or may not come, right? With all the tariffs that are in place today. And again, I don't know exactly when we're going to be airing this, but one of the really biggest mitigating factors that we want to employ is making sure that we're making loans at the correct leverage, right? We never want to over leverage any of the loans that we make. And that's why we want to make sure that every single one of our borrowers has skin in the game. So if you look at our portfolio today of all the loans that we have, on an average between closing costs and the start of the construction, the borrowers are about 30% skin in the game into the deal before we have to deploy any additional funds to the borrower on the construction draw. That for us makes me feel comfortable, right? In addition to that, today the average after repair value leverage against the assets that we have on our portfolio is right around 58%, which means that there's about 42% of equity built into the deals once the project is completed for us to find comfort in knowing that in order for us to really be concerned about losing principal on the deals and the loans that we're making, we would probably have to see about a 40% price decline or depreciation in US real estate. And what I like to say is that, if we see a 40% decline in real estate across the US, wherever our money is, it's probably in trouble, right? And I think having that built in kind of automatically through the systems and the policies and the procedures that we've built in over the past, say, 6 or 7 years is really what puts me to sleep every single night.
Yeah, that makes sense, Ruben. Let's talk a little bit about the due diligence that you perform on the borrower itself. We talk a lot about, doing proper due diligence on the sponsor, the operations team. We know that there's a lot of distress, in the market right now. Some of that distress is on the operations side. Some of it's on the financial side. We preach to investors all the time that you're, not investing in the deal or the business plan. You're investing in the operator or the jockey, right? So maybe you can kind of break down for us, from a high level, what your due diligence process looks like.
So first, we look at the asset, right? We want to know exactly what we're lending against. We really like to be focused on multifamilies, 1 to 4 units, or mixed-use properties. And the reason why we like to be focused on those asset classes versus, the number of other asset classes that are out there, for example, retail, office, right, industrial, is because what we've learned, and just kind of looking at data across so many years, is that the residential asset classes, whether it's a multifamily commercial building, whether it is a 1 to 4 unit or a mixed use unit, they've been a bit more resilient in headwinds versus the other asset classes, right? I mean, look at what's happening with office. Industrial is doing obviously very well, depending on what's going to happen. And look at some of the headwinds that retail has experienced. What we've learned is that residential does not really experience the same kind of volatility as the other asset classes. So we try to focus on residential type of asset classes. So one, we look at the asset. We want to make sure that there is enough meat on the bone, that there is the property is valued at what the borrower is saying it's going to be valued, but also the exit strategy makes sense, right? And if it doesn't make sense, we want to make sure that in the event that the borrower cannot sell for the price point that they expect to sell, and again, they're a little bit optimistic based on what we discussed before, we do a stress test. We want to make sure that in the event that the borrower cannot sell and does not want to sell because he's going to be taking on that loss, if he does sell, is there going to be enough income producing from the property to be able to service our debt, or be enough to be able to take out our loan through a DSCR loan, a debt service coverage ratio loan, or a bank statement loan, and then we kind of shift our focus, right, from the asset to the borrower, right? Who is the borrower? Does he have experience, right? How's his credit look? Does he have any bankruptcies? Does he have any foreclosures? So we do a full background search. We do a full credit search on the borrower, but also we take a very deep dive on the borrower's experience. So a lot of our borrowers, they provide us a personal financial statement along with the schedule of real estate owned. We check every single property that the borrower claims they're connected to. And I say claims for a reason, right? Because a lot of borrowers, they like to kind of say, hey, I've been connected to these 10 deals. And this is one of the things that, a lot of private lenders like myself kind of face and deal with. The challenge that we deal with every single day is we want to make sure that we're dealing with operators that are experienced. So if they give us a list of 10 deals that they've done in the past, we want to make sure to check every single property to see that they are directly connected to those assets. And if they're not, well, then they're not an experienced operator. It's not to say that we're not going to lend to them. It's fine. We'll still lend to you, but not at the leverages that you really anticipate at the time that we discussed the deal when you told us that you have 10 deals as experience. In that case, we want you to have more skin in the game, because obviously the less of experience that you have, obviously the higher risk the loan is. So, you being able as a borrower, being able to put more money down to the closing or on the deal would make us more comfortable to make the deal.
Yeah, that makes total sense, Ruben. Now, no crystal balls here, okay? But where do you see the greatest opportunity in private lending over the next 12 to 24 months?
There's one thing about private lending is, again, it's not a kind of get rich fast kind of opportunity. It's more of a stay rich opportunity, right? It's something that gives you monthly cash flow, diversified amongst a number of different asset classes, first lien positions, person guaranteed by the borrowers. It's really kind of a safe type of investment. I think a lender who has the backing of a institution is really where they're going to shine, right? Because you don't know what's going to happen, right? You don't know what direction or where the wind is going to take us, especially with the administration that we have today and the tariffs that are putting so much pressure on the market today. So I think being able to have the right backing, being able to have the right liquidity or enough liquidity is really, really where the opportunity lays.
Yeah, makes total sense. And I appreciate you sharing that future focus. I'd like to ask you a vulnerability question, if you don't mind, as we kind of look to wrap up here. And that is, what's the most valuable lesson you've learned in your career that's helped you build a successful business?
I think one of the things that I am so fortunate with is the family I have around me, but also the many friends that I was able to develop over the many years of being an adult, even to this day, I mean, I have friends that I've known since I'm 6 years old, right? And that's something that, not many people can say. And I think one of the biggest reasons why, I have so many friends, and my family is always near and dear to me, and by my side, is because I do what I say, and I keep my word on everything. And I think that in and of itself is, if you say something, you do it. If you promise someone to do something, you do it. Your word is your bond. Your word is everything about you. I think having and keeping your word, doing what you say and saying what you do, is really, really important. I think that's one of the greatest lessons I've learned over the many years, because not only do your kids appreciate that, your wife, your family, but also all the friends that you're able to then eventually do business with, right? And I think that's one of the greatest accomplishments that I can really contribute my success to, is having the many friends that I have today.
Yeah, I really appreciate you sharing that, and absolutely resonates with me, and I'm sure others. But, you talked about, showing up, being consistent, following through. All those things do one thing, and that is they build authenticity with others. And when you build authenticity with others, that's the cornerstone of building trust. And when people trust you, right, now you're coming from a trust-based relationship, and those types of individuals can absolutely accomplish more than those that don't build authenticity, if that makes sense.
Totally. You hit it on the head. Well said.
Great. Well, Ruben, this has been a pleasure. I really appreciate the tremendous value that you've brought our listening audience. Is there a couple of different ways that maybe our listeners can connect with you offline to learn more about what you're up to?
Totally. We're on all the major social media platforms. Our handle is We Lend LLC. We're on Instagram. We're on LinkedIn. We're also even on TikTok. But they could also always reach out to me directly at my cell, 917-815-1222, or our website, www.welendllc.com.
Great. Well, we'll put those links in the show notes for the episode. Ruben, again, thank you for joining us.
Thank you, Jeremy. It was a pleasure.
Of course. And listening audience, thank you again for jumping into another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.